Hey guys, today I want to talk about an important topic, and that is tax planning. And tax planning is something that there's some things you can do throughout the year, and really you should be doing throughout the year. However, it's at the end of the year that some things need to be done, and really the time that most people look at stuff because time's running out. It's now or never for your tax planning. Plus, a big deal with tax planning at the end of the year is you know what your income is for the year. So you know exactly what your tax bracket is. So I just want to run through a few quick ideas today of what you can look at here at the end of the year. So number one is Roth conversions, okay? Right here. And I've got that as number one because that's something that can apply to everybody, all right? It's something everybody should look at the end of the year. Maybe it's a fit, maybe it's not, okay? Lots of reasons to do it. There's also reasons not to do it. But Roth conversions, especially if you're retired, okay? Income changes in retirement. Maybe you're retired early, before Social Security age, or maybe you are of Social Security age. You got your supplement leading up to age 62. Now you're not getting that supplement and you're gonna delay collecting Social Security. So you may have lower income for a number of years until you start collecting Social Security. That is a great tax planning window to where maybe you want to do conversions in that time. Number two, QCDs. What is a QCD? QCD is a qualified charitable distribution, okay? This is something I recommend anybody and everybody look at that is age 70 and a half or older and gives money to charity, okay? With the Tax Cut and Jobs Act of, I think it was 2017, after that took place, most people now take the standard deduction versus itemizing on their taxes, meaning if you give money to charities, you most likely don't itemize on your taxes, okay? This year the standard deduction is like $27,700 or $27,800, something like that. So most people do not itemize, so you get no tax benefit for charitable giving. But qualified charitable deduction allows you to take money from an IRA and gift that directly to the charity and not pay any income taxes on it. Also, it can satisfy your RMD. Okay, now RMDs aren't happening until age 73. Also, there's a couple rules you got to know in there, but can satisfy an RMD, and the money goes there, and you don't pay any tax on it. Okay, so if you're in 12% tax bracket, it saves you 12%, 22%, it saves you 22% versus giving that out of cash flow. A great way to save money on taxes. Three, donate appreciated assets. Okay, this is another charitable giving thing. So you may notice a lot of these things that have a theme in them as charitable giving. Okay, so it's two or three of the topics. If you're doing charitable giving, these definitely apply to you. Donating appreciated assets, okay? So again, instead of giving money to a charity out of cash flow, okay, what you can do is if you have a taxable account and you have stocks, mutual funds, ETFs, some kind of asset that's appreciated, you can gift that asset and not pay any taxes on the gains, okay? So if you have a stock that's valued at $10,000 and you bought it for $4,000, if you were to sell that stock, you have $6,000 of gains that you have to pay taxes on, okay? Well, you can gift that stock to the charity and then you don't pay taxes on that $6,000 and you still get the full deduction if you happen to itemize, okay? Now you have to have held the stock for 12 months to be able to do that, but could be a great fit for a lot of people. There's no age limit for doing that, okay? That's something I do at the age of 45, so it can apply to anybody. Four, tax loss and tax gain harvesting. Okay, this is a practice to get in. Again, if you have a taxable account, which I'd recommend anybody try and establish that. It's good to have accounts outside of TSP or other than just TSP. So tax loss harvesting, that involves selling positions that you bought and that are lower at the end of the year, okay? So this year, bonds haven't done so well. Maybe you have bond positions that haven't done very well. What it allowed, and last year, it was stocks that didn't do well, and bonds, neither did well last year. But It allows you to sell a position at a loss and you can buy back a similar position, therefore not changing your portfolio by much. Now keep in mind there's a wash sale rule. You cannot buy back a position, you can't buy back the exact same position for 30 days, or you can't buy back I forgot exactly what the wording is, but it can't be too similar of a position. All right. So you want to know what you're doing there. But what it does is it allows you to offset $3,000 of losses from income in that year, carry over the rest to subsequent years and deduct $3,000 a year, or offset gains or future gains, okay? Now, another one that's a big deal that a lot of people don't think about is the tax gain harvesting, okay? And I've had this happen with multiple clients that they're retired and now they find themselves, and it may just be for a period of years, in the 12% income tax bracket, okay? If you're in that 12% income tax bracket, guess what your capital gains rate is? It's 0%, all right? So what that means is if you have a taxable account and you have appreciated positions, as long as you stay within that 12% income tax bracket, then you can sell that position, okay? And your tax rate is 0% on that. Now keep in mind, this is federal. You may have state taxes, but your tax rate is 0%, okay? So you just sold a position, say that you have let's take the example from before, $4,000 a basis, it's worth $10,000. You sell it, okay? And because you're in 0%, you don't pay any taxes on that $6,000. And then you can buy back the position for $10,000, okay? There's no time limit. You don't have to wait a certain period of time there like you do the wash sale rule for losses. You can buy it back, and now your basis is $10,000 versus $4,000, all right? So there's some details there as far as taxes go, but as long as you stay within that 12% tax bracket, 0% taxes on capital gains. What else? Last one, bunching deductions. All right. So this is something that you may want to check out or may want to look into if you find yourself, really this is going to be for people that give a decent amount to charity every year. And the most common place I find this is people that tithe and give money to their church. And then it's giving. It's giving to anybody. So to sum up bunching here kind of briefly is you can tax deduct your mortgage interest, you can tax deduct real estate taxes, you can tax deduct things like charitable giving. Okay, so those are your three main ones. And then you can tax deduct state income taxes. They're called SALT taxes for the acronym. Now a lot of, I believe, actually SALT taxes are capped at $10,000, okay? So you're capped out at $10,000, then you have mortgage interest, then you have charitable donations, okay? A lot of people are not going to hit that $27,800 or $700 standard deduction level with those three deductions, okay? So then they don't get any tax benefit from those. But what you could look at is bunching those deductions into 1 year, okay? So take a person that their deductions are going to be something like $25,000 versus $28,000 this year. What they could look at doing is maybe gifting to charity right now before the end of the year for next year, okay? And then they double that up, and let's say that's another $13,000. Now they have deductions of $38,000, which now allows them to itemize, okay? And then save some money on taxes this year. Or prepay real estate taxes, prepay mortgage interest, really anything that you can prepay in this year. Now some entities don't allow you to do that stuff, but charitable giving is the main thing when it comes to bunching deductions, okay? And you can save yourself a couple $1,000s doing stuff like that. So a few ideas for you. Remember, it's not necessarily about making the most money, but yet keeping the most money that you can. And really that's what tax planning is, okay? Tax planning is just using the tax laws to your advantage, okay, to keep more of what you have and what you make, all right? So If you don't know much about these things, it sounds like any of them might apply. Please educate yourself or seek the right help to figure out how to do this stuff. And again, if you need help from me, you can look down in the comments or details section. I'll put a link down there. I'll also put a link to an article or two about this stuff. Okay? And again, general financial planning, always seek advice from your local, your advisor, your tax person, tax attorney, estate attorney, whatever it may be. Thanks, guys. Bye.